This is a podcast from the Business Times.
U.S. stocks rallied overnight, with all three major indices ending the day higher, despite the escalating military tensions between the United States and Iran, as investors regain some confidence in technology stocks. Crude prices fell after briefly touching $80 a barrel on Wednesday, this after the U.S. announced new strikes on Iran. Meanwhile, a rather volatile week for Asia, particularly in the tech-heavy markets, with South Korea falling into a bear market on Wednesday. Where do they go from here? Welcome back to Market Focus Weekly. I'm Clarissa Montero, standing in for the vacationing Howie Lim. It's Friday, July 10th, 2026. I'm joined by Raisah, Rasid, Global Markets Strategist at JP Morgan Asset Management. Welcome back.
Thank you. Thanks for having me.
We have a lot to get into, so let's do that. US-Iran, they've resumed hostilities, reigniting concerns over Middle East oil supplies, sending crude prices higher. So should we expect prices to climb back to the heights of the US-Iran war levels? Because, just earlier this week, we were talking about an oil glut.
It's true. So, if you take a step back, I think we were always of the view that the ceasefire would still raise questions about the durability. We didn't think that it was the end of the conflict. So the renewal of the conflict that we saw in the Middle East, which prompted President Trump to say he thinks the ceasefire is over and that the US may reinstate its naval blockade of the Strait of Hormuz, that basically caused the oil prices to jump nearly 6% on the day in response to it. But if you look at where oil prices are today, which is about $72 per barrel, since I last checked, it does not actually challenge our view that last quarter shock around this Middle East is fading and that global growth will likely continue to move at an above potential pace for the rest of the year. So even if we're thinking about the downside, we're still expecting a US economy that is growing on trend, at least for the second half of the year. But I think what this reignition of the conflict is a stark reminder that the Middle East conflict is not resolved. And we should really keep in mind the risk of a larger than expected energy sector disruption. Now, so the questions going ahead should be, how should investors really position portfolios? Bear in mind that this conflict could really run a lot longer. Now, our base case is that we will see some level of de-escalation and ceasefire momentum. Bear in mind that we do have a US midterm election coming up at the end of the year, and affordability concerns will be top of mind. And we did see the impact of the Middle East conflict on US gasoline prices, which will be very central as we're heading into the midterm elections towards the end of the year. But, I think going forward, if you're thinking where will oil prices move, we were always of the view that oil price will not revert to pre-war levels fairly quickly. Even if we do get some stabilization of the situation, you will be faced with reopening frictions, inventory building for some of the countries that would likely inflate oil prices to higher demand. And just think about insurance costs, right, that would be involved. So this likely will keep oil prices, at least through the rest of the year, above that $65 to $70 range that we saw pre-war. That being said, it doesn't mean that investors should stay on the sidelines. There's always going to be opportunities as well, because what this Middle East conflict really did is to kind of bring back again that conversation about energy security. So there is another theme that investors who want to really dilute some of that concentration risk in AI, this could be looking like another possibility as well.
Okay, let's move very quickly, since we did say we have a lot to cover. The Magnificent Seven underperformance. Poor June, and it doesn't look very sexy right now. Markets also become increasingly capex fatigued. On top of that, I actually saw that the CBOE Nasdaq Volatility Index spiked to its highest level to the VIX since the dot-com era. That's a big statement. The question then is there increasing doubt around AI investments translating to profits?
So short answer is no. And the way that we look at it is that if you look at US AI adoption rates, that's picking up very healthily. And what this means is that this will actually bring in the revenues that some of these spenders need, and that would really fuel that CapEx channel. So there is some basis around why some of these hyperscalers are spending billions and billions more and constantly revising up their capex outlook. However, I think what's happening right now is that the winners of AI is constantly evolving. So we're now, in short, moving from spenders to builders. What investors are rewarding is not the dream of AI, but rather the gratification that you get, which is why you're seeing a lot of the semiconductors and the hardware companies doing really well because the earnings momentum is there. So you are seeing a lot of these investors actually coming through for those hardware piece. So I think in short, the AI story is not broken. It does remain a structural growth theme, but it does appear to be the case that market is becoming a lot more selective. Valuations for the Max 7, though, they're a lot more attractive following the pullback. So for long-term investors in this AI theme, this is an opportunity to add exposure. But what you want to do is to add that exposure alongside having the exposure to the broader AI ecosystem. So we're talking about industrials, we're talking about power, utility, and really taking advantage of AI beyond the current winners, which is the semiconductor space. So what we want to do as asset managers is how do we find the next winner of AI? And we think it would likely be in robotics as well as autonomous vehicles.
All right, so staying on the AI theme a little bit, moving to Asian markets. South Korea briefly entered bear market territory earlier this week after Samsung's earnings did disappoint investors, highlighting the risk of heavy AI concentration. In South Korea and Taiwan markets, should investors rethink their exposure, or are there other markets in Asia that offer more diversification opportunities?
From where we sit, we don't think that investors should abandon South Korea or Taiwan as a AI play. But I think what the recent volatility actually is a reminder that concentration risk does matter, right? Both markets have become highly exposed to that relatively small group of AI-related winners. So we're talking about the semiconductor companies in Taiwan as well as the memory chip companies in South Korea. And when a company like that comes in with a report that really disappoints, it does raise questions around AI spending and monetization concerns, and that will trickle down and be felt by the entire market. But what's important to note and what investors should remember is that the AI story itself remains intact. The issue today is less about AI demand. We know that that's exponential, but the question is how much will investors be willing to pay for that growth and whether AI investors will be able to generate sufficient returns. So as a result, we're seeing that market leadership really broaden beyond the original AI winners. So for investors looking to reduce concentration risk, the opportunity set in Asia is really not confined to South Korea and Taiwan. It's becoming more diverse. Parts of Southeast Asia, select opportunities in China offer exposure to also domestic consumption. We're seeing a lot of companies adopting AI, and that really in the longer term does provide some basis to earnings in the longer run.
Still to come, more on the memory chip sector and ASEAN.
Market Focus Weekly, now hosted by Howie Lim. A sharp weekly deep dive into what's moving markets in Singapore and across the region, with analysts and market insiders to break down the forces shaping the week ahead. New episodes every Friday, powered by the journalism of the Business Times. Find Market Focus Weekly wherever you get your podcasts.
Welcome back. It's Market Focus Weekly. We're speaking to Rasid, the global market strategist at JP Morgan Asset Management. Raisah, turning your attention back to the AI trade, SK Hynix will list in the US today after being oversubscribed multiple times. Is this a sign that investors should be looking to increase exposure to memory chip names?
Yeah, so I mean, the strong demand around the company does highlight an important point. Investors continue to believe that memory remains one of the clearest beneficiaries of the AI build-out. As we mentioned, we are seeing that rotating winner of AI moving away from spenders to the builders, and memory is really one of the key builder, right, in this entire theme that we're talking about. And if you think about generative AI applications, they require a lot more high bandwidth memory than traditional computing workloads. And that really has transformed the outlook for leading memory producers who are constantly on the lookout to upgrade some of the chips as well. But what investors should remember is that memory has historically been one of the most cyclical areas of technology as well. So while the recent enthusiasm really reflects expectation for continued AI infrastructure spending, that should likely continue. So for investors who are thinking, hey, this might be cyclical because of how memory chip tends to behave in the past decade or so, do remember that this is a slightly different story we're talking about. We're talking more of a structural theme that is really associated to the new frontier of AI, that is generative AI.
Let's turn our attention to Indonesia. S&P Dow Jones follows MSCI in putting the market on watch lists for reclassification. What might the impact be on Indonesia's equity market?
Yeah, so a downgrade to frontier market, all else equal, it would clearly be viewed negatively in the short term because benchmark classification matter, right? Some global investors, if you think about it, they're only mandated to invest only in emerging markets. So the sort of reclassification could result in portfolio outflows and lower passive investment allocation, especially if you're buying an emerging market benchmark, which no longer house Indonesia as that. But that said, I would really distinguish between market classification and economic fundamentals also. So yes, a benchmark change can affect capital flows and sentiment, but it doesn't necessarily change the long-term earning outlooks for select Indonesian companies. And maybe the focus will always remain on, so which company would do well on a more structural basis, right? So the key question is whether policymakers can address some of the concerns that was really raised during that review process as well. In the near term, investors should really expect volatility, but over a longer horizon, I think fundamentals such as where will domestic consumption go, how will infrastructure development be financed, and what is Indonesia's role in the regional supply chain, those would be key in really driving equity returns over a longer term. But remember, as asset managers, we do active stock selection. So we don't really approach some of these equity index from a passive perspective as well. So like us, I think investors should really stay very active and really focus on stock fundamentals and macro backdrop rather than news flows such as this.
Okay, so let's now come home to Singapore. Singapore is preparing for the next phase of its equity market overhaul, including the launch of the SGX Nasdaq Global Listing Board and the appointment of a third batch of equity market development program managers. Do you think the reforms will be enough to ignite investor interest and improve the competitiveness of our local stock market?
So, yes and no. I mean, the reforms are certainly moving in the right direction. I think one of the long-standing challenges for the local equity market has been attracting growth-oriented companies and improving trading liquidity. So, in that sense, some of the initiatives that we've seen, the SGX Nasdaq Global Listing Board, the continued rollout of the Equity Market Development Program, those are great into addressing that. But market revitalization is really achieved through a single reform package. Investors' interest would depend on having attractive companies, sufficient liquidity, strong research coverage, etc. So reforms are necessary, but they're not sufficient on their own. The success by it should not be measured by just simply the number of new listings, right? But whether Singapore can create a deeper ecosystem that can attract both issuers and investors over time. So one thing that's encouraging is that policymakers appear committed to improving market competitiveness. So I think if we're continue moving in the direction, I think we will see a more liquid and attractive equity landscape in Singapore.
That will be good.
Yeah, for all of us.
Yep. Okay, so last one. The Japanese yen is at a 4-decade low against the USD. And this is despite rate hikes from the BOJ. Can we expect or do we anticipate intervention? And how effective do you think that intervention would be?
Yeah, so I think one thing to understand is that the yen's weakness is fundamentally a reflection of the large interest rate differential. Because remember that Japan is slowly coming out from this low interest environment, and we are expecting potentially that the Federal Reserve might hike rates, right? I think that's what market is being priced in right now. And also the fact that the government is still rolling out fiscal packages. But at the same time, you are seeing that the macro backdrop is suggesting that this economy is prime for a hike. You're seeing very positive signals from the corporate sentiment surveys. Inflation is heating up. So this is an economy that really requires that rate hike, right? But the Bank of Japan has begun to raise rates, but the Japanese yields, it does remain low compared to the US Treasury yield. So the incentive for capital to flow abroad does remain strong. Could we see intervention? Yes. The probability always rise when you do see very large swings in the currency moves. But I think the more important question is, will intervention be effective? Now, historically, intervention can slow or temporarily reverse currency moves, particularly if it catches markets off guard. But what you do need for a sustained appreciation would be support for underlying fundamentals, such as narrowing interest rate differential. So I think, just in short, intervention will provide some short-term relief, but the longer-term direction of the yen will still really much depend on, number one, the US monetary policy, number two, Japanese inflation dynamics, and also the future path of the BOJ's tightening cycle.
Raisah Rasid, Global Market Strategist at JP Morgan Asset Management. Thank you for joining us today.
Thank you for having me.
Well, that's it for this week's Market Focus Weekly. We'll be keeping a close watch on what happens next. If you have any questions or feedback, drop us a note at btpodcast@sph.com.sg. Till next Friday.
This is a podcast by the Business Times. Find more BT podcasts at businesstimes.com.sg/podcasts. Or wherever you get your podcasts. This podcast is meant to provide general information only. SPH Media accepts no liability for loss arising from any reliance on the podcast or use of third parties' products and services. Please consult professional advisors for independent advice.